To build one of NVIDIA's flagship H100 GPUs, it costs roughly $6,400 in physical parts and manufacturing. To buy one, it costs upwards of $30,000. That massive spread leaves the chip designer with an implied gross margin of about 82%. Markets have looked at this figure and concluded that NVIDIA possesses absolute, durable pricing power. But that 82% margin is a structural illusion. It is the single most exposed variable in the entire artificial intelligence hardware stack. NVIDIA's margin structure is better understood as a residual. It is simply the surplus left over after paying two highly concentrated, supply-constrained manufacturing monopolies. And that surplus only survives if the company can successfully defend it against a customer base of 4 tech giants who are actively trying to replace them. Assuming this margin is permanent misprices the physical reality of the AI boom, and it masks where the true leverage in the supply chain actually lives. Let's look at the hardware stack as a vertical bill of materials, everything required to physically build an AI accelerator. NVIDIA's contribution encompasses RTL design, verification, and the CUDA software ecosystem. That is critical work, but it accounts for only 14% of the physical product's cost. Despite that, NVIDIA captures more than 75% of the final selling price. The remaining 86% of the hardware flows to external suppliers, who are currently underpricing their manufacturing services relative to their importance in the system. This creates a mechanism we can call the margin vice. Upstream suppliers are raising costs to capture more value, while downstream customers are pushing prices down to lower their capital expenditures. NVIDIA's outsized margin sits squarely in the middle. To evaluate NVIDIA's long-term valuation, we have to look past their current market cap and measure the exact force closing in from both ends of this vice. We start at the bottom of the vice, upstream silicon manufacturing. Every Blackwell and Rubin accelerator relies on TSMC's advanced packaging, known as CoWoS. It is the absolute binding constraint on global AI chip production. Demand for this packaging is compounding at 113% annually, and there are 0 alternatives capable of operating at this scale. This relationship is a textbook bilateral monopoly. NVIDIA cannot source this advanced packaging anywhere else, while TSMC relies on NVIDIA to consume 60%. That floor is reinforced by a second upstream constraint, high bandwidth memory. AI models require massive memory scaling. We are seeing a jump from 80 gigabytes of HBM on the H100 to a projected 288 gigabytes on the upcoming Vera Rubin architecture, a 3.6x increase in just 3 generations. This memory is supplied by a strict 3-player oligopoly: Samsung, SK Hynix, and Micron. Their global production capacity is fully sold out through 2027. HBM already accounts for 45% of a GPU's total production cost, and these vendors are actively negotiating 20% price increases on long-term supply agreements. For the first time in the history of the semiconductor industry, memory vendor gross margins are approaching and in some quarters exceeding those of TSMC. These price hikes compound multiplicatively with TSMC's rising fees. NVIDIA is trapped paying an increasingly larger share of its hardware costs to suppliers who hold total leverage. At the top of the margin vice sits NVIDIA's customer base, an oligopsony of 4 cloud hyperscalers who account for over 40%. Simply having a credible alternative allows these 4 buyers to threaten to redirect 15 to 25%. This table breaks down the comparative total cost of ownership. Neoclouds are exploiting their immediate leverage by forcing developers into multi-year offtake agreements to lock in higher rates and maximize their return on invested capital over the lifetime of the cluster. While NVIDIA fights a high-stakes margin war in the procurement phase, the immediate cash flow leverage has temporarily shifted entirely to the operators holding physical compute capacity. The pieces of the margin vice are fully locked in. NVIDIA's residual margin is being violently compressed by monopolistic suppliers raising costs from the bottom and an oligopsony of hyperscalers chopping prices from the top. The AI hardware stack operates as nested bilateral oligopolies competing for the economic surplus. Ranking these layers by physical scarcity, TSMC's advanced packaging is the tightest bottleneck, followed by high-bandwidth memory, then wafer fabrication, and finally chip design. Yet, the financial markets price these layers in the exact inverse order. The highest multiples are assigned to the most substitutable layer, chip design, while the physical gatekeepers trade at steep discounts. When the $600 billion data center capital expenditure race eventually rationalizes, hyperscalers will target cost reductions. The supplier commanding the highest margin will be the first one brought to the negotiating table. Compute capacity is no longer an infinitely elastic expense. Long-term profitability now relies entirely on controlling absolute physical limits. The true winners of the AI infrastructure boom will not be the companies that design the most GPUs. The winners will be the ones who control the inescapable physical bottlenecks and capture the most surplus per dollar spent.